Enterprise Finance Daily Banking, Risk, and Corporate Market Insights. Daily AI-powered insights for finance professionals, investors, and enterprise decision-makers. Corporate Finance and Banking. Global banks and corporations are navigating a complex financial landscape with cautious optimism. After weathering a bout of instability in previous years, major banking institutions have reinforced their balance sheets and fortified liquidity buffers, earning renewed confidence from investors. Corporate earnings have been resilient, with many multinational companies beating profit expectations and boosting shareholder dividends, signaling that businesses have adapted to higher borrowing costs. Credit conditions are gradually loosening as inflation shows signs of easing from its peak, relieving pressure on corporate borrowers and sustaining capital investment plans. This regained momentum is feeding into stock market sentiment, lifting financial sector stocks and suggesting that the corporate world is positioned for steady expansion. The interest rate environment remains a central focus as corporate treasurers and bank strategists plan for the second half of the year. Global central banks, after an aggressive round of rate hikes to tame inflation, have largely shifted to a more measured stance, with some even considering rate cuts if economic data permits. Expectations of a possible peak in interest rates have improved corporate planning visibility, allowing companies to refine debt strategies and repricing loans to minimize the cost of capital. Banks, benefiting from elevated net interest margins, are cautiously adjusting to a potential end of the rate upcycle by locking in longer-term funding at current levels. Still, the consensus is that rates will remain within a range conducive to business growth, helping sustain corporate loan demand and investment in both developed and emerging markets. Within corporate finance, strategic mergers and partnerships are gaining pace as companies seek scale and innovation. After a slowdown in 2024 to 2025, a great M&A rebound is underway in 2026, with firms pursuing transformative deals to strengthen their market positions. Banks themselves are not standing still. They're expanding by acquiring fintech startups and even regional rivals to gain new capabilities and broaden their customer bases. These bold moves are propelled by robust cash reserves and a refreshed appetite for strategic risk, illustrating how corporate leaders are envisioning growth akin to exploring new markets on the frontier. The result is a dynamic corporate sector that, much like a spacecraft breaking through the stratosphere, is pushing the boundaries of what's possible in search of the next wave of revenues. Focus. Central banks chart a new course. This week, a string of central bank meetings has underscored how divergent global conditions are shaping monetary policy. The Bank of Canada opted to hold its key rate steady at 2.25%, weighing trade uncertainties and a recent tariff shock against still elevated energy costs. In contrast, the European Central Bank ended a years-long easing streak by raising its deposit rate to subdue rising prices, its first hike since 2023. The Bank of Japan, long accustomed to near-zero rates, signaled a rare willingness to tighten policy to support a weakening yen after import costs surged, highlighting how even historically dovish central banks face new pressures. Meanwhile, in the United States, the Federal Reserve appears split, with some officials contemplating another rate increase later this year if inflation fails to retreat toward target. Despite these differing approaches, central bankers share a common challenge. They are responding to supply-driven price shocks with tools designed to manage demand. For corporations and banks, each decision holds significant implications, from borrowing costs to currency values, reinforcing the vital link between policy choices and the trajectory of corporate growth. Fintech and RegTech. Financial technology and regulatory innovation are surging ahead in 2026, fueling a new wave of efficiency and inclusion across the financial sector after a challenging correction last year that tested the fintech industry's resilience. The sector has rebounded strongly as startups and established institutions double down on digital transformation. Fintech revenues worldwide have once again climbed, and leading digital finance firms are reaching record valuations thanks to revived investor appetite for high-growth ventures. One major factor is the mainstream adoption of tools that were once experimental. Instant payment systems are now standard at banks, and stablecoins, digital tokens pegged to traditional currencies, have become integral to cross-border transactions and corporate treasury operations. Businesses and consumers alike are embracing these innovations to speed up settlement times and reduce costs, enjoying near-instant payments and more accessible services. This widespread integration of fintech solutions into everyday finance signals a maturing industry that has shifted from the fringes into the core of global commerce. Regulatory frameworks have evolved in tandem with this fintech renaissance, providing clearer guardrails that encourage innovation while protecting markets. Policymakers across the U.S., Europe, and Asia have introduced comprehensive digital finance rules, from guidelines on open banking APIs to formal licensing regimes for crypto assets and digital currencies. Europe's landmark markets in crypto assets law is taking effect, bringing stablecoins and crypto exchanges under robust oversight to strengthen user and investor confidence. Likewise, new U.S. legislation focused on payment stablecoins has clarified their legal status, enabling traditional institutions to integrate them without fear of regulatory ambiguity. Meanwhile, advances in RegTech, regulatory technology, mean banks and fintechs can automate compliance tasks like real-time transaction monitoring and digital identity verification using AI, dramatically improving speed and security in an era of rising cyber threats. By modernizing oversight alongside innovation, regulators are fostering a safer environment for financial technology to thrive. Startups are scaling faster under predictable rules, and established banks are far more willing to partner with or acquire nimble fintech players. As competition heats up, consolidation is rapidly reshaping the fintech landscape, blending disruptive innovation with the stability of established financial players. Cash-rich banks and tech giants are acquiring smaller fintech firms to bolster their digital capabilities, from global payments platforms to AI-driven risk analytics tools, bringing new technology in-house. At the same time, well-funded fintech leaders are merging with peers to create one-stop financial platforms offering everything from lending and payments to wealth management and insurance, effectively becoming universal digital banks. This race for scale has led to a flurry of high-profile deals, highlighting the sector's belief that synergy and size will be key for long-term success in a competitive market. Fintech companies that weathered last year's turbulence by pivoting to profitability are now leveraging improved market sentiment to pursue initial public offerings at strong valuations, feeding broader stock market enthusiasm for tech-driven firms. The result is a fertile environment for continued innovation that will serve the next generation of customers. Focus. Stablecoins transform global transactions. A recent surge in enterprise adoption of stablecoins for payments and treasury operations underscores fintech's growing influence on mainstream finance. Industry data shows the total supply of regulated stablecoins, once dismissed as niche crypto tokens, has exceeded $250 billion this year, with annual transaction volumes now measured in the trillions of dollars, rivaling some traditional payment networks. Corporate finance chiefs are increasingly using these dollar-pegged digital coins to streamline cross-border trade and liquidity management, enabling near-instant, low-cost transfers that bypass slower banking channels. Regulatory clarity, including new laws in key markets, has been pivotal in building trust. With governments setting rules for issuance and reserves, more banks are integrating stablecoin transfers into their platforms. Central banks, too, are acknowledging the trend and studying how privately issued digital currencies might coexist with official monetary systems in the future. What was once a speculative experiment has become a practical tool, as stablecoins transition from the fringes of fintech to a fundamental component of global financial transactions. Risk management and insurance. Confronted with an evolving array of threats, risk managers and insurers are doubling down on strategies to bolster resilience. The past year brought a litany of challenges, from costly cyber attacks to extreme weather events shattering previous records, heightening the urgency for robust risk mitigation. Global insurers saw insured losses from natural disasters exceed $100 billion last year, prompting heavy investments in advanced catastrophe modeling and climate analytics. This renewed focus on understanding climate risk is evident as companies integrate data on wildfires, hurricanes, and floods more deeply into their pricing and underwriting decisions. On multiple fronts, organizations that proactively adapt by enhancing their ESG readiness, digital fortifications, and disaster response plans are better positioned to withstand future shocks and maintain stakeholder confidence. The insurance industry is starting to see a gradual easing of some pressures, even as it contends with an era of higher volatility. Reinsurance markets, which had been hardened by back-to-back years of heavy catastrophe payouts, are finally seeing new capital flow in, bringing some relief and more flexible terms. This influx of investment in reinsurance is beginning to stabilize premium costs for primary insurers, enabling them to offer broader coverage options and even innovative products for complex risks. Property and casualty insurers report that demand remains high for specialty coverage such as cyber liability and supply chain disruption insurance, areas of growth driven by the emergence of new, interconnected threats. To meet these challenges, insurers are embracing digital tools like real-time data analytics and predictive AI to refine their risk models and expedite claims processing, which improves accuracy and customer service. Meanwhile, regulators are urging insurers to maintain robust capital reserves and transparency, reinforcing stability and safeguarding policyholders even as uncertainty remains elevated. Emerging trends show how the boundaries of risk management are expanding, and with them, the scope of insurable frontiers. The concept of operational resilience has taken center stage as companies aim not just to survive disasters, but to adapt and thrive through them. From climate resilience initiatives to comprehensive business continuity planning, enterprises now treat resilience as a strategic imperative rather than a mere compliance checkbox. Innovative insurance solutions are on the rise as well. Parametric insurance policies, which pay out automatically when predefined event thresholds, like a certain wind speed or earthquake magnitude, are reached, are growing more popular as a way to provide faster relief after disasters. Such products reflect the industry's shift toward proactive support in times of crisis, offering near-immediate payouts to communities and businesses in need. And as humanity's ambitions extend beyond Earth, encompassing space tourism and even off-world ventures, insurers are beginning to consider how to price the risks of space travel and extraterrestrial assets. This broadening scope, paired with a people-centric ethos, underscores the insurance sector's commitment to guarding individuals and enterprises on every new frontier. Focus: climate resilience drives innovation. A spate of early-season extreme weather alerts has pushed climate risk management to the top of corporate agendas, catalyzing fresh insurance solutions. As meteorologists predict an intense upcoming hurricane and wildfire season, insurers are rolling out new offerings such as community-scale parametric disaster policies, which promise swift payouts to families and businesses when triggered by specific climate conditions. Major reinsurance firms have launched initiatives to pool resources for climate-related catastrophes, spreading risk globally in anticipation of bigger storms and heat waves. There is also growing collaboration among insurers, tech companies, and governments on better early warning systems and resilient infrastructure, aiming to reduce losses before disasters strike. Investors are taking note. Shares of insurers with strong climate adaptation strategies have been rewarded, reflecting confidence that these companies can manage risks and seize opportunities as climate concerns grow. In parallel, new regulations require large corporations to disclose their exposure to climate dangers, pressuring executives to integrate adaptation measures into long-term planning. By turning challenges into opportunities for innovation, the risk management and insurance sector is playing a critical role in safeguarding not just assets and earnings, but also human lives and livelihoods in the face of a changing climate. Investment and capital markets. Stock markets are riding a wave of optimism as 2026 reaches its midpoint, with major indices hovering near record highs amid strong economic and technological tailwinds. The Dow Jones Industrial Average recently crossed the 50,000 mark for the first time, buoyed by a broad rally spanning technology, finance, and energy stocks. The S&P 500 and Nasdaq Composite have likewise posted robust year-to-date gains, driven by surging demand for technology shares and a rebound in corporate earnings that defied expectations of an economic slowdown. Market sentiment is underpinned by a belief that the worst of inflation may have passed and that central banks will remain measured and data-driven going forward. Investors have been emboldened by sustained consumer spending and solid business activity as moderate economic growth stays on track despite earlier headwinds. Many observers are even referring to this period as a new bull market era for the digitally driven economy. A standout narrative this year is the AI-fueled tech boom that has captured investors' imaginations worldwide. A frenzy over artificial intelligence and next-generation computing has propelled the valuations of leading tech firms to stratospheric heights, adding trillions of dollars in combined market capitalization to the sector. This exuberance has largely outweighed lingering macroeconomic worries, such as elevated inflation or higher interest rates, though some analysts warn that price-to-earnings ratios are beginning to look reminiscent of past bubbles and emphasize the need for strong earnings to validate today's lofty stock prices. The balancing act between optimism and caution is growing more evident as traders watch whether the rapid ascent of AI-driven stocks can be sustained or if a correction might eventually bring valuations back to earth. For now, the tech sector's strength continues to be the engine of broader market gains, reflecting both genuine innovation and a potent narrative of future opportunity. Meanwhile, global capital markets are adapting to shifting conditions in policy and geopolitics without losing momentum. In Europe, stock indexes have lagged U.S. markets due to a slower growth outlook, and the European central banks return to modest interest rate hikes to contain inflation. Emerging economies are seeing mixed fortunes. Some benefit from stabilizing commodity prices and revived tourism, while others face capital outflows as a strong U.S. dollar and geopolitical tensions weigh on sentiment. Bond yields have found an uneasy equilibrium, with investors now expecting a long plateau for interest rates instead of the rapid changes witnessed in recent years. Corporate debt issuance is picking up as companies lock in financing for expansion, a sign of their confidence in the future business climate. And in currency markets, divergent central bank policies are nudging exchange rates. Hints of a U.S. pause coupled with European tightening have lifted the euro slightly. Thus far, these cross-currents have not derailed the overall positive tone, as capital markets demonstrate resilience in incorporating new information while staying on an upward trajectory. Focus. Tech IPOs spark investor euphoria. A booming initial public offering window has opened this quarter, symbolizing a renewed risk appetite in capital markets. SpaceX, the private spaceflight pioneer, made a landmark public debut. Its stock surged nearly 20% on opening day, securing one of the largest valuations in IPO history. Hot on its heels, other tech titans like OpenAI and prominent fintech unicorns are lining up their own mega listings, eager to tap into investors' fervor for transformative technologies. These deals reflect not only confidence in individual companies, but also the market's hunger for exposure to new frontiers of innovation, ranging from artificial intelligence breakthroughs to ambitious space enterprises. The rush of IPOs has been met with intense demand. Institutional and retail investors have clamored for shares, with many offerings heavily oversubscribed. Market watchers suggest that a sustained revival of public listings could boost trading volumes and highlight the renewed vitality of equity markets after a lengthy lull. While some caution that speculation is partly fueling these sky-high debuts, the resounding success of these IPOs so far has reinforced a narrative of renewal and possibility, echoing a broader sense of adventure and opportunity in the financial markets of 2026. AI and data analytics in finance. Artificial intelligence has evolved from a buzzword to a linchpin in the financial industry, as firms of all types leverage data-driven algorithms to sharpen their competitive edge. On trading floors and in boardrooms alike, AI-powered systems are processing vast datasets in real time, uncovering market patterns that would have eluded human analysts in the past. Banks and investment funds are deploying machine learning models to forecast market trends, optimize portfolios, and detect fraud with unprecedented accuracy. Perhaps most visibly, AI chatbots and virtual assistants are handling routine customer service and advisory interactions at scale, allowing human professionals to focus on more complex, high-value tasks. The fusion of human insight with AI precision is creating a powerful hybrid model where technology augments decision-making and productivity while people maintain creative and strategic oversight. This financial AI revolution extends beyond the front office to the behind-the-scenes machinery of compliance and operations. Natural language processing tools now scan mountains of regulatory text and corporate filings in seconds, summarizing key points and alerting compliance officers to potential issues. In risk departments, AI models simulate countless scenarios, from interest rate shocks to global pandemics, to help firms build robust contingency plans. Insurance companies are using advanced data analytics to refine the pricing of policies by incorporating a wide array of risk indicators, improving fairness and financial soundness. Meanwhile, concern over algorithmic bias and transparency has led regulators to begin crafting guidelines for AI's use in areas like credit decisions and trading, ensuring that the technology's rapid deployment does not compromise ethical standards. Across the sector, the discussion has shifted from whether to adopt AI to how best to govern it. Institutions are establishing oversight committees, stress testing their algorithms for fairness, and training their workforces to collaborate effectively with intelligent systems. The result is an industry more data-informed than ever, moving swiftly yet carefully into an era where AI is as integral to daily operations as spreadsheets once were. Traditional banks are partnering with tech firms and startups to access cutting-edge AI tools and upgrade legacy systems. Some forward-looking institutions have even created internal AI research labs or incubators, aiming to develop proprietary models that could set them apart in the marketplace. The push for stronger data analytics is enabling more personalized financial products, from robo-advisors that create custom portfolios to behavior-based analytics that tailor insurance coverage to individual needs. These developments promise not only improved profitability, but also a more inclusive financial system, as AI-driven efficiencies reduce costs and extend services to underserved customers. There is a growing recognition that advanced analytics must ultimately serve people. For instance, AI-enhanced credit scoring is opening new opportunities for borrowers with thin credit histories, and automated financial education tools are helping individuals make smarter investment decisions. With each breakthrough, the frontier of possibility expands, turning science fiction concepts into practical tools. In this way, the finance industry continues to reinvent itself, using the power of data to navigate uncharted markets, much like a mission control steering a course through the stars. Focus: Wall Street embraces autonomous agents. The adoption of AI has reached a new milestone as major financial institutions begin opening their systems to autonomous software agents for complex tasks. In a pioneering move, Morgan Stanley announced it will allow corporate clients to plug their own AI-powered assistants directly into the bank's wealth management and stock plan administration platforms. By granting controlled access to its data pipelines, the bank aims to let these agentic AI tools handle routine administrative functions and analytics at scale, freeing up human staff for higher-value advisory work. Rival firms are also investing heavily in similar capabilities. Some have deployed generative AI internally to write code and automate compliance documentation, moving closer to a future where algorithmic coworkers assist across many roles. Regulators are monitoring this trend closely, emphasizing that proper safeguards and transparency must accompany any handover of duties to machines. Still, the industry consensus is that collaborating with advanced AI agents, rather than shunning them, will be crucial for maintaining a competitive edge in an increasingly digital market. As one Wall Street executive put it, they are teaching the machines to help us push the boundaries, capturing both the excitement and the caution in this next chapter of finance's intelligent automation. Global markets aim for the stars in Tech-Driven Rally. Disclaimer: this content is for informational purposes only and does not constitute legal, medical, financial, or official advice. The stories and analysis presented should not be taken as personalized guidance or recommendations. Video description: In this forward-looking edition of Enterprise Finance Daily, we explore 5 vital financial sectors that are shaping tomorrow's market landscape. We delve into corporate banking's strategic moves and interest rate shifts, breakthroughs in fintech and regulatory tech, proactive risk management and insurance innovation, the current investment climate and capital markets, and the transformative role of AI and data analytics in finance. Each segment offers deep insights and a positive, futurist outlook on how technology, resilience, and human-centric innovation are driving the financial world into new frontiers, from stablecoin-fueled transactions to space-age market ambitions. Video tags: finance news, stock market, corporate finance, banking, fintech, regtech, risk management, insurance, investment, capital markets, AI and finance, data analytics, stablecoins, financial technology, global economy, market trends, innovation, space economy, future of finance. Base thumbnail concept: a bold, futuristic design blending finance and space themes. The background features a city skyline and a rising stock chart that transforms into a rocket launching towards space, symbolizing financial markets taking off. Overlaid text in bright, modern font reads Enterprise Finance Daily across the top and Future of Finance at the bottom, grabbing attention and highlighting the forward-looking tone of the report. A, B/C thumbnail variants. A. Tech and Markets Fusion. A split-screen image with a glowing AI digital brain on one side and a booming stock market chart on the other.